Good afternoon and welcome to Market Mondays. This is Seng Yao, and today I will be standing in for Dylan as he's out of the country. As we begin the month of September, it is important for us to take stock of what a volatile month August has been and the drivers that moved it, as some of these same drivers could inevitably infect market sentiments this week. So, to recap, the first trading week in August started to sell off on the release of weaker than expected July non-farm payrolls, which basically prompted fears that the Federal Reserve might have waited too long to begin cutting interest rates. The unwind of the Japanese yen carry trade at 150 yen to the dollar further added fuel to the sell-off. The yen is often considered a safe haven currency, meaning that investors tend to buy yen during times of global economic uncertainty or market volatility. This demand can cause the yen to appreciate against the US dollar during such periods, which was what we witnessed in earlier August when the yen strengthened from 150 to 142 over a very short period of time. Fast forward to this week, consensus for the August jobs report stands at 165,000 based on the median estimate in a Bloomberg survey of economists. This compares with the modest 114,000 gain that we saw in July. So if numbers basically come in within range, there's a good chance that markets will continue to stay stable. But there remains a big disconnect between the stock market and the Fed funds futures market, with the Fed funds futures basically continuing to price in 100 basis points over the Fed's remaining three policy meetings in 2024. This implies that the Fed would hopefully deliver one supersized 50 basis point cut at some point before the end of the year. Last Friday, the core personal consumption expenditures price index, or the PCE price index, basically it's a metric that the Fed prefers to use to measure inflation trends. That number which strips out the volatile food and energy items, increased 0.2% from June. On a 3-month annualized basis, which is basically what economists prefer to use basically to forecast the trajectory of the inflation, that number now stands at a 1.7% growth in inflation for 2024. And that number is basically the slowest this year. This is as Goldilocks as it gets for PCE. So consumer disinflation, it's very clear that consumer disinflation is on track with this set of data. Since the August correction, the stock market has come back very strong, with the S&P now seeking to re-challenge its all-time high of 5,669. Will the yen hold at 145 to the dollar? Will the US non-farm payrolls come in the sweet spot range? These will be some of the key markers that markets will scrutinize this week. Whatever the outcome, I think it's fair to say that the Fed is expected to cut by at least 25 basis points in the upcoming policy meet on 19th of September. SREITS in particular comes into our focus today because this segment, this class of securities tend to move in anticipation of interest rate changes. And at this juncture, it is my great pleasure to invite Jialin onto the call to walk us through the SREITS sector. Jialin, hi, welcome to the show. In your report, the focus is of your report is built around the sensitivity of different REIT segments to the current interest rate cycle. But before we get to this, these details, let's first talk about the fundamentals. What are currently the SREITs pricing in from a dividend yield standpoint for this year? Okay. And what's that spread over the 10-year government bond yields? Could you help us with this first question, Jialin?
Thanks for having me, Seng Yao. The trailing rates index is trading at 5.6% dividend yield last week, coming down from the high of 5.9% in early August, suggesting a brighter market expectation in the recent rally after the more definitive tone by Powell's speech. Spread over 10-year government bond yield is at 2.9%, comparing to the 15-year average of 3.2%, and year-to-date, tighter spread of 2%. But the spread was shortly back to the 3 to 3.2 region in early August. So now we are close to the average spread over yield. As the spread continues to widen, we could expect some rotation back into SREITs from the bond and T-bill markets.
Okay, that's a very nice chart that you're showing right now. So if I look at the three lines, the red dotted line is basically the average
The average. Yeah.
spread, okay? And then I believe the top line and the bottom line is the plus minus one standard deviation, which is how wide the spread could actually trade over extended periods of time, correct?
That's right. That's right.
Okay. So you're optimistic. The point here is that you're optimistic that there's still headroom for this spread to widen further.
Yes. So far we are seeing that we are still below the average spread over yield. And on a longer term basis, if we are looking at 15 years retrospectively, we are still there is still gap for the spread to close.
Okay.
To widen further.
Okay. All right. Well, can you then let us know then which sectors within the S-REITs category is actually leading DPO growth?
Yeah, so within our coverage, we are forecasting a highest 2-year CAGR for DPO growth for commercial segment, followed by industrial and hospitality segments.
Okay, all right. So based on your report, you are basically neutral on office. Is that
Yes.
because of vacancy concerns from major new developments, for instance, the Odeon 333 and the IOI Central Boulevard buildings, projects?
Yeah, like you have said, our view is that it takes time to ramp up occupancy with all these new schemes coming on stream. So for example, this year we already had IOI Central Boulevard and it hasn't reached a full occupancy yet. So our channel checks is that it is pre-committed at 60%. Guokou Midtown, it came on stream last year and it still has single digit vacancy remaining. And for next year, we have Keppel South Central, Labrador Tower, Shell Tower, as well as Paya Lebar Green. So for Keppel South Central and Paya Lebar Green, they are estimated to be going at between 12 to 13 per square feet region. And for Paya Lebar Green and Labrador Towers, they are estimated to go at sub-9 per square feet region. So the pre-leasing at Keppel South Central is set to be quite low key. So it really takes time for the market to absorb all this supply coming on stream, and we are seeing resistance to current price level. So demand is slowing, spot rents growth have also slowed down. And another concern for our familiar names like Keppel REIT and Suntec REIT is that they are not pure play Singapore office REITs. So they both have significant office components, definitely, but conditions for their offshore offices remain quite challenging and valuations are still under pressure.
Okay, great. Thank you. So let us now talk a little bit about hospitality REITs. Your preferences on the two other segments, which we'll cover very shortly. What are your concerns about the hospitality REITs? Can you give us some details on this?
Yeah. So for hospitality, for hotels specifically, the trend is definitely a moderating RevPAR, with RevPAR data coming in lower, either half on half or quarter on quarter. So one thing to note is that year on year RevPAR change are still positive, mostly positive, which suggests that we have largely moved past the stage of recovery post-pandemic from a year ago. and seasonality or events are now at a larger play across key markets. And then while hospitality tourist arrival growth is not as strong as we had expected, forward guidance for second half or 3Q this year is facing steeper competition as compared to last year. So we will need to see better growth of tourist arrival and subsequent pickup in RevPAR for us to relook at this sector.
Okay, that's logical. Just to be just to exercise more prudence and caution, to wait until the
Yes,
arrivals data improve before you turn positive on the hospitality sector. Got you. Now let's
that's
talk
right.
about
That's
the
right.
last two sub-REITs, the SREITs sub-segments that you like, which is basically the retail and the industrial sub-segments. So starting with retail, can you comment on recent trends in vacancy and rentals and why this is looking quite interesting to you?
Yeah, sure. So overall, our view on retail is that rental reversions are relatively strong. Occupancy are full or close to full. So we could give you some data. Let's say, for example, for City, first half reversions are at 9.3%. For Sembcorp, it's at an amazing 21% reversion, and occupancy ranges between 95.6 to almost full for City, FCT, and Sembcorp REITs. For second quarter, there might be seasonal impacts from locals traveling overseas, but managements are generally optimistic about tenant sales growth, especially for suburban retail sales. But of course, apart from the strong reversion and occupancy, we are seeing slowing of flattish tenant sales in recent months, which might weigh on tenant reversions going forward. But as long as domestic consumptions, employment, tourism arrival are on a stable track, we do expect the fundamentals for retail scene to remain robust.
Okay, all right. Let's talk about the last segment, which is the industrial segment. What are the trends that you see, and why does it look so positive to you?
Yeah. So for industrial, occupancy still range between 91 to 97% across our coverage list. Reversions are between 2.6% for MLT and to 12.8%. I mean, all in all, while reversions this quarter are still robust, high double digit or even higher reversions we are seeing some normalizing trend over there. But occupancy largely remain robust on strong logistic demand.
Okay, all right. Well, I have one more question for you. I hope you can help the audience appreciate the what we just discussed earlier in terms of the interest rate events that we're watching very closely and the impact that has on the SREITs sector. There are in your report basically 6 stocks that you highlighted, some of which you've already gone through in the last 2 minutes or so in this Zoom call. Can you quickly just talk us through the debt, the sensitivity of the interest rate environment and the 6 stocks that you like within the retail and industrial sector, starting with Capital Land, CICT?
Yes, of course. So for size, maybe just a overview on the sensitivity of different segments. So as you know, we are moving towards the last quarter of this year. So the impact from lower borrowing rates will come in a larger force next year. So now the larger and more immediate impact we can see are from a lower cost of capital priced by the stock market, which will take account in our dividend discount model, and a lower discount rate and improvement in fair value estimates by the transaction market, So we expect every 50 bips decrease in the discount rate to improve fair value by about 10% on average. And coming to the year end, the change in fair value will likely be reflected in the balance sheet versus savings from interest expense in the P&L. So overall, if interest goes down, SREITs across all segments will definitely benefit from the lower interest expense as well as improved valuation. But overall, our top picks will remain for CICT, CLAR, CLAR, and FCT with a Singapore-centric revenue stream and a diversified presence in high growth sectors and good hedging practice. So these are from a fundamentals perspective. And the names that we think will benefit from a high level of from this rotation and transition between a high level of interest rates to a normalized level will be L-rate, MLT, and OE rate in our top picks.
Okay, great. Thanks so much for this summary. To our audience, all of these calls, 6 calls that Jalin just shared, are available in standalone reports. So kindly reach out to your sales reps who would be more than happy to help you retrieve these reports so that you can get more details out of these 6 names. Okay, thank you, Jalin, and we look forward to speaking to you again soon. Okay, so I'm going to bring in my next speaker right now, and we're going to basically shift our attention to the Hong Kong market as well as to tech stocks. Now, there's been a lot of interest in Hong Kong tech stocks, basically since PDD's 30% crash last week when it missed the market estimates. PDD is listed in Nasdaq and owns the popular online e-commerce platforms Pinduoduo and Temu. During the earnings call, what had happened was that the firm said that revenue growth would face pressure due to intensified competition and external challenges. And there were basically no plans at all for dividends or share buybacks. As of this week, this development is very important for the Hong Kong market because the Hong Kong Stock Exchange has just launched weekly options on the Hang Seng Tech Index beginning today. This index basically includes Alibaba, JD.com, and perhaps and other tech stocks as well. So to help us get a sense of the technical developments with the tech sector, I've invited my assistant Amirul to walk us through in terms of his observations on these some of these stocks. So Amirul, welcome to the show. First, let's take a look at PDD, the US listed stock. Is the worst over?
All right.
Amirul?
Hi, Sanyao. Thanks for having me. So in order for me to answer your question, I think it would be best if I could share my screen first. Okay. So I hope you can see my screen now.
Yes.
Okay, so wait, right. All right, so from what we can see here, I actually have drawn several things on my charts for PDD holdings. So if you can see here, the price actually made a huge gap down move, which shows that a very huge negative sentiment can really happening to the share price. But then again, if you can see here, let me try to draw something here. Okay, if you can see around my rectangle pattern around here, you can see that the price is actually trying to move up again. But then for me, in order for the bulls, for let's say to take over, the price has actually need to take over the first resistance first around here. But then for me, even though the price has taken over the resistance one over here, I think the bulls still has not the upper hand yet, because for me, in order for it to have like a full upper hand, it could actually need to beat this resistance line around here, which is the resistance 2. So for me, the downward move pressure is still there. So in order, if let's say, most people are thinking that, oh, now it's making a big down move, you can actually buy the stock counter in a huge discounted price. But then again, you have to time your buy point correctly. So if you can see here, another point I would like to make here, even though the previous candles are showing like a doji candle, which is a very small body candle, which is actually an indecision between bulls and bears, but you can actually see that the counters are making like a huge rise in volumes as compared to the previous months, which shows that the sentiment is not yet clear whether the bears or the bulls want to make a move. So that's why if let's say you want to make a buy, it has to beat at least the first resistance first, or probably if you want to be safer, it has to beat the resistance to first. Then only I would say that the bulls would have the upper hand. So that will be it for PDD.
That's great advice and observation here, Amiru. For
Mm.
our audience, just a reminder that the US markets will be closed tonight, and when it opens tomorrow, kindly take note of this observation on PDD. So, Amiru, let's now go to Hong Kong. One of the most the easiest way to basically buy a tracker on the Hang Seng technology sector is to basically utilize this ETF called the CSOP HStech ETF. The stock code is 3033.HK. Amiru, maybe just walk us through what you see on this chart, please.
All right, so for CSOP 3033HK, right? So if you can see, I have drawn like a pattern here. So basically the index just broke above the triangle pattern here. So basically when an index or a share price broke above a triangle pattern, it shows a bullish move, right? But then usually a breakout above this pattern usually could lead to a false breakout. So in order for you to get rid of that false breakout, so what you can do is to actually look at the EMA line, right? So I have drawn here three different EMA lines, EMA 13, 50, and 88. As you can see here, I have said something around here. The price needs to close, or the index need to close above the 88 EMA line for the breakout to be validated. So if not, the price is just making a new high for it to be corrected later. So I think if you could just wait a little bit, and if you could break and also close above the 88 EMA line, it will be a good signal, a good bullish signal for me, Sanjay.
Okay, great. Thanks.
Mhm.
And Amiro, before we let you go, there is a question from the floor on this stock, Sembcorp Industries. I wonder if you could help us to pull out that chart and tell us whether it's an interesting point to either buy or to pay careful attention to. Amiro?
All right, so I have the chart over here with me, Sanyao. So actually this chart looks very interesting for me because first of all, right, as you can see here, there's a pattern forming around this base around here. So if you can see, if I draw this path around here, so this one, this one, this one, this one, this one, and the last one over here. So this looks like a inverted head and shoulder pattern. So an inverted head shoulder pattern, right? It is a very good signal of a bullish reversal pattern. Because why? Because if you look at the pattern, right, and then the next thing you want to do is you want to draw the neckline pattern, right? So if you draw the neck pattern around here, so the stock is about to break the neckline pattern, right? So it shows that the bulls now has strength. It doesn't have the upper hand yet because it still does not break the neckline pattern. But then for me, the bulls have strength now for two reasons, because it almost about to break the neckline pattern. And also the second reason, it will be that because the share price also now trading above all the EMA lines, which shows that, okay, now the bulls have strength. But then for me, a good buying point will be above the neckline pattern. Then only I will say the bulls is ready to make a new uptrend. So I think
Okay.
that's my view on that.
Okay, great. Thank you so much for
Mm.
your deep insights on these three stocks.
Thank
Well,
you.
we look forward to speaking again with you very soon. Thank you,
Thank
Amir.
you for having me, Daniel.
Okay. All right. We're close to the end of our program right now. But before we end, just three highlights to share with our audience. The first of which is basically that Maybank Securities Singapore has basically just launched a Telegram channel. Yes, the Telegram has been in the press a wee bit of late, but the point here is that with this Telegram channel, we'd be able to share some of our more interesting insights with our clients, make it easier for you to get this information every week, right? So I'm going to ask my colleague to basically flash that QR code right now. Take a moment to basically snapshot that, and you get connected with our Telegram channel. Okay. Shenhao, if you could just share that. While he's doing that, let me just also kind of walk you through in terms of some of the key dates that we'll be monitoring for the macroeconomic events. As I alluded to earlier, the most important event this week will be the non-farm payrolls report that will be released on Friday. Okay. The next event would be the FOMC meeting in September. That is going to start on 18th of September and will basically end on 19th of September, where we'll get the minutes and information about what the Fed thinks about the current interest rate cycle. Okay. Last but not least, tomorrow marks a very important day for Maybank Securities. We will be hosting our charity event. It's called Trade for Good. Basically, what this event involves is that every dollar of commission that comes to the firm, a fraction of it will be donated to our charity cause. You know, if the markets are looking up for you this week, you believe some of these ideas that we have shared, please trade with us and do good for some of our charity organizations as well. So with that, we've come to the end of the program. Thank you again, as always, for your generosity and your commitment to trade with Maybank Securities. We hope these ideas have given you some intel. If you like what you've heard, give us a thumbs up. You know, this will help us basically refine our program and make it better for you. So with that, thank you so much for listening in. Happy hunting this week, and we look forward to having you again next Monday. Thank you.